Several years ago, a trader visited the renowned trading psychologist, Mark Douglas. This trader was an exceptional market analyst, possibly one of the best Mr. Douglas had ever met. Despite his analytical skills, he faced years of frustration, leading to losses not only for himself, but also for others. After discussing with this trader for a while, Mark Douglas identified several significant psychological barriers hindering his progress. Among these obstacles were his know-it-all attitude and extreme belief in his market analysis skills, and these prevented him from achieving the necessary mental adaptability required for effective trading. Despite his analytical prowess, Mr. Douglas realized there was no way he would succeed in trading as long as he had these psychological barriers. So Mr. Douglas suggested that instead of seeking another investor for yet another failed trading attempt, the analyst would be better off finding a job where he excelled. This would allow him to earn a steady income while addressing his trading-related issues. Following this advice, the analyst secured a position as a technical analyst with a major brokerage firm in Chicago. The brokerage firm's chairman was a seasoned trader with nearly 40 years of trading experience in the grain pits of the Chicago Board of Trade. But the chairman lacked familiarity with technical analysis since he never needed it to be successful on the trading floor. As he transitioned to screen trading, he found it challenging and enigmatic. The chairman requested the newly acquired hotshot technical analyst to mentor him in technical trading, using the point and line method popularized by Charlie Drummond, which also worked as support and resistance. During one trading day, they were observing the soybean market together, and the analyst projected major support and resistance points. As the market was trading between these 2 points, the analyst emphatically stated that if the market reached resistance, it would reverse, and if it reached support, it would also reverse. The analyst further claimed that if the market hit the calculated support level, it would mark the low of the day. As the soybean market slowly trended down to the support level predicted by the analyst, the chairman turned to him and asked if the market was expected to stop there and rise. The analyst confidently responded, yes, affirming that it was indeed the low of the day. However, the chairman disagreed and demonstrated his doubt by placing a large sell order, causing the market to drop 10 cents a bushel in just 30 seconds. Witnessing the market's unexpected movement, the analyst was shocked. And the chairman pointed out to the analyst that if he could make support break with a single order, anyone could do it. As traders, we might have found ourselves in situations similar to the analyst's experience. The difference is that we didn't have the opportunity to witness firsthand the decisive action that broke the support or resistance point, leading to a shift in market structure. Trading is inherently unpredictable, and even the most skilled analysts can encounter unexpected outcomes. It's necessary to understand that the markets can behave in ways that defy our predictions. You should know that anything can happen, and it takes only one trader to do it. This is the hard, cold reality of trading that only the very best traders have embraced and accepted with no internal conflict. So, allow me to introduce you to your new best friend in trading: risk management. Just like a loyal companion, risk management will stand by you and protect you in your trading journey, ensuring you're able to navigate the markets safely and confidently for as long as possible. Risk management is a crucial aspect of successful trading, aimed at protecting capital and reducing the impact of potential losses. Traders use various risk management techniques to safeguard their investments. Such techniques include setting stop-loss orders to limit potential losses, diversifying portfolios to spread risk, and determining the appropriate position sizes based on their risk tolerance and market conditions. The question you might have now is how you can go about properly implementing risk management. Well, here are 5 key strategies to effectively implement risk management in your trading. Number 1. Set your risk tolerance. When it comes to risk management, the first crucial step is to recognize your risk tolerance. Your risk tolerance is your ability and willingness to endure a decline in the value of your position. It's a critical element of trading. encompassing both your financial capability and emotional readiness to withstand changes in the value of your open positions. When I started to learn trading, the advice I got from the trading gurus was to use a minimum of 1 to 3% of my trading capital. Foolishly, I decided to go with the higher end of that suggestion. After a few losses, I was down almost 15% and lost my head. Of course, you know what happened afterwards. After the many not-so-good episodes of blown accounts and my exposure to prop firm trading, I now risk a minimum of 0.25% of my trading capital and a maximum of 0.5% per trade. I could lose that percentage of my bank over and over again and not lose my head. That is my risk tolerance. And it works for me. The old Wall Street adage, "Do you want to eat well or sleep well?" captures the trade-off between taking on higher risks assets and the potential for substantial gains. Suppose the idea of enduring significant declines in your investments or losing sleep during volatile periods makes you uncomfortable. In that case, you may need to adjust your portfolio to better align with your risk tolerance. Balancing risk and reward is a personal decision, and it's crucial to strike a balance that allows you to pursue your financial goals while staying within your emotional comfort zone. Number 2. Use stop-loss orders. A stop-loss order is an instruction given to a broker to automatically exit a trade when the price reaches a certain level, preventing larger losses if the trade goes against you. Suppose you purchase 100 shares of ABC Company at $50 per share, and you want to protect your investment in case the stock's price declines. You may decide to set a stop-loss order at $45 per share, which is 10% below your purchase price. If the stock's price starts to fall and reaches $45 per share, your stop-loss order will be triggered. At that point, your broker will automatically execute a market sell order for you, and you will sell your 100 shares of ABC Company at the prevailing market price, which could be around $45 or slightly lower when you factor in your broker's commissions. This way, your potential loss will be limited to approximately 10% of your initial investment. At one point in your trading journey, I'm sure you've declined the invitation to set a stop-loss order. And of course, it didn't end well. By using a stop-loss order, you would have protected yourself from further losses when the price continued to go against you. Using stop-loss is a risk management strategy that basically allows you to preserve your capital, and this allows you to go again if the market presents you with another trading opportunity. Number 3. Use take-profit orders. A take-profit is a tool similar to a stop-loss, but with the opposite purpose. While a stop-loss closes trades to prevent further losses, a take-profit automatically closes trades once they reach a specific profit level. Profit-taking as a risk management strategy is not talked about enough, but it's one of the most important. Setting clear expectations for each trade allows you to determine a profit target and an appropriate level of risk. Many traders aim for a 2-to-1 reward-to-risk ratio, where the expected reward is twice the risk taken on the trade. For instance, if your take profit is set at 20% above your entry price, the stop loss would be 10% below, which is half the distance. In summary, setting profit levels helps maintain discipline and encourages considering risk versus reward in trading decisions. Number 4. Limit the use of leverage. Leverage presents traders with the chance to amplify their profits. Yet, it simultaneously increases the risk potential by magnifying losses. For instance, a 1:100 leverage signifies that with a $1,000 account, you can trade up to $100,000. If the market moves favorably, you'll reap the full benefits of a $100,000 trade with just a $1,000 investment. Conversely, this advantage reverses if the market goes against you. Opting for higher leverage heightens your exposure to trading risk. For those new to trading, a prudent approach to risk management is to curtail exposure by avoiding excessive leverage. It's best to consider the use of leverage only when you have a true understanding of potential losses. By doing so, you can avert significant portfolio losses and steer clear of unfavorable market outcomes. Number 5. Avoid emotional trading and prepare yourself for the worst outcome that could happen. Financial asset trading is notorious for its unpredictability. But when you are mentally ready for the worst is when you're managing your risk properly. Remember the story of the analyst from the beginning of this video. The lesson from that story is that no matter how well you understand the market you're trading, unforeseen price movements are more common than you think. And you must have a well-thought-out plan for such scenarios when they occur. By being prepared for the worst, you can navigate through turbulence and effectively protect your trading capital. Remember that you can't control the market, but you can control your response to it. And how are emotions and risk management related? Well, you won't apply or stick to all the risk management strategies discussed in this video if your emotions are all over the place. Emotions have the power to cloud rational thinking and drive hasty choices. Adhering to your trading plan and refraining from fear-driven or greed-based decisions is crucial. By maintaining discipline and objectivity, you can enhance your trading success and sidestep the pitfalls of emotional impulses. Avoid overtrading and practice being patient for high-probability trading opportunities that you've already decided upon. Rushing into trades can increase the likelihood of taking unnecessary risks. The Trading in the Zone book by Mark Douglas is good education if you are still struggling with your emotions as a trader. I did a summary of the book in a video that you can find up here and in the description of this video. I will end this by saying that no trading strategy can completely eliminate risk, but effective risk management can help protect your capital, keep you in the game so you can play again, and eventually improve your overall trading performance. If you made it to the end of this video, I appreciate you. If you found this video helpful at all, please destroy that like button, subscribe to the channel, and turn on the notification bell so you don't miss it when I drop videos like this in the future. Thanks for watching.